Hi, welcome back. I'm your mortgage chef, Cal Kier. In this video, I'm going to teach you the pros, the cons, and the difference between a variable and fixed rate mortgage. But before we go any further, please hit that subscribe button and like this video so you don't miss the next one. Okay, let's get into it and let's start cooking. Let me set the scene for you and let's keep it simple. We can talk about how interest rates are calculated by the lenders, but really, it's a reaction of the Bank of Canada setting their bond rates and their overnight rate. The Bank of Canada sets the stage for how lenders come up with their own rates, and each of them can be just a little bit different. Now, I'm not going to get into either of those right now. We'll save that for another video. But I just want to talk about the differences between a variable and fixed rate. So, what is a fixed rate mortgage? A fixed rate mortgage is a regular payment that stays the same, and so does the interest rate. A fixed rate mortgage is a lower risk mortgage for you. And the reason for that is the payment won't change, and nor does the interest rate that you'll pay over the term of the contract. You'll know all the risks going into it, and they won't change. You do have a concern, though, is that should you wish to pay that mortgage out early, the penalties can be a little higher than a variable rate. But this is a perfect mortgage for somebody on a budget, just like a first time home buyer, because you'll know your payment and it won't change for the entire term. Now, knowing this, you should also know that there's three types of mortgage rates out there that are advertised. There's an insurable rate, there's an uninsurable rate, and there's an insured rate. Oh my goodness, it can be completely confusing. Again, I'm not going to get into the specifics of those, but know this. When you see something advertised, in most cases, it's an insured rate. And these insured rates are also the ones that in some cases make you pay a premium of almost 4%. So when you see a great rate like 1.99, it's probably more like 5.99 because the lender doesn't have to advertise the potential 4% premium. Are you still with me? That's a whole lot of information, I know. So drop me a question in the comments below and show me you're still following along. Now let's take a deep breath and let's keep going. Now, what are variable rate mortgages? There's the ones that I recommend to the clients in today's economic climate. History has shown that if the prime rate fluctuates, it almost always works out to be an advantage in savings in the long run than a fixed rate mortgage. So right now, if you get a variable rate mortgage, maybe somewhere around 3% mark, here are some of the possible challenges with it. If you have a variable rate payment and the interest rate goes up, your payment will also go up. That can be a bit of a challenge. But the good news is if the interest rate goes down, so does your payment. More good news is I can probably get you a fixed rate payment along with a variable rate mortgage, which is perfect for the person on a budget because you get the benefit of a variable rate mortgage and your payment won't change. Crazy, right? And at the very end of it, it's all adjusted and your equity at the end of the term. So if you qualify for a fixed rate payment and a variable rate mortgage, oh my goodness, say that three times really fast. It's definitely helpful for people who work around on a budget. It makes your budget planning much, much easier. Give yourself a pat on the back for taking in this learning. What's the biggest takeaway for you here? Did you learn something new about a variable rate or a fixed rate mortgage? If so, leave me a comment down below so I can answer your questions that you might have. Remember, your mortgage needs to work for you, and when you work with your mortgage chef, we'll always slice and dice the best rate for you. Cheers to smart mortgaging. See you on the next video.